Overnight, $850 million vanished from the crypto market. It was a brutal reminder of how quickly wealth evaporates. The damage was systemic. Bitcoin, Ethereum, and Solana all plummeted in a sudden, sharp downward spike that caught retail buyers completely off guard. This chart shows the exact mechanism behind the collapse, a liquidation cascade. When traders borrow money betting prices will rise, a sudden drop forces their exchanges to automatically sell assets to cover the debt. That forced selling drives prices down further. It operates exactly like a financial earthquake. When the market shakes, any position built on heavy leverage and borrowed money is violently destroyed. But for investors holding solid, unleveraged assets, these events offer a different perspective. They use the chaos to acquire assets at a discount, while the overleveraged get wiped out. This event followed a months-long buildup of invisible macroeconomic pressures. When that tension finally broke, the result to release was violent, immediate, and required a deep look at the underlying forces to understand. The first major pressure point sits completely outside the crypto ecosystem, the US dollar. Right now, it is acting as a massive global counterweight to risk. Historically, there is a strict inverse relationship here. When the dollar gathers strength, risk on assets like Bitcoin and even traditional stores of value like gold get pushed down under its weight. The second pressure point is inflation. Recent U.S. economic data showed inflation running hotter than expected, sending a wave of panic across all global markets. Sticky inflation forces the Federal Reserve into a defensive posture, meaning they have to delay cutting interest rates. For digital assets, this is suffocating. High interest rates choke off the supply of cheap, easily borrowed money that historically fuels massive speculative crypto rallies. Together, a strong dollar and high interest rates acted like a vice. They slowly squeezed the upward momentum out of the market, trapping retail buyers who were trading entirely on surface-level hype. While those external forces squeezed from the outside, internal market mechanics began to buckle. Institutional smart money started quietly heading for the exits. Large entities that rode the previous upward rally began aggressively booking their profits. As they sold off their holdings, they stripped away the foundational buying support holding prices up. Then came miner surrender. Running these massive operations requires enormous electricity and constant overhead costs. Following the Bitcoin halving, mining rewards were cut in half, but power bills stayed the same. Miners were forced to dump their reserves onto the open market. This diagram illustrates the breaking point. The weight of a strong dollar, profit booking, and miner sell-offs pushed Bitcoin down until a critical technical support level snapped. That broken price floor triggered thousands of automatic algorithmic sell orders, initiating an unstoppable chain reaction. This crash functioned as a mechanical breakdown. Once these internal pressures pushed the market beyond its structural limits, the collapse followed the cold logic of technical trade triggers and automated liquidations. The immediate aftermath of a drop like this is highly psychological. Retail investors scramble, panic, and sell their remaining portfolios at a massive loss. However, experienced traders always maintain strict discipline. They know that emotional, fear-driven selling is the exact mechanism that transfers wealth from the impatient to the patient. The first rule is avoid the panic sell. Instead, use deep discounts to acquire assets with solid fundamentals. The second rule is strictly defensive. Never trade without setting a hard stop loss. If macro pressure continues, the floor can drop further. Moving forward, smart capital is waiting on the Federal Reserve. Their next move on interest rates dictates the rhythm of the global market cycle. In this ecosystem, volatility remains the primary constant. While panic forces losses for some, those who focus on fundamental research are the ones who remain after the dust settles.